I mean, this is what I call superinflation, and we're rapidly getting back to 1970s levels of inflation. And we will have high and higher inflation for many years to come, along with the financial repression. It could last 30 years.
This week's specials with Miles Franklin Precious Metal Investments. 2022 Silver Britannias for only $3.95 over spot, and 2022 Silver Maple Leaf coins for only $5.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And with us today is Jonathan Davis, economist and wealth advisor from Jonathan Davis Wealth Management. Jonathan, thank you so much for joining us today.
It's my great pleasure, Elijah.
Now, you've recently stated that with the inflation that we're seeing right now here in the U.S. and also where you are in the U.K., here in the U.S. we're seeing 30-year high inflation. In the U.K., where we just got the numbers out, 10-year high inflation. Your perspective on this, and you've mentioned how this is not going to be transitory. It's not just going to be for a little time. It's actually we're entering a new era, and this could go on for decades.
Yes, and for a number of reasons. The primary one, because the politicians and the central bankers and bankers want it. It's really that simple. And there's no question about it being transitory. That is arrant nonsense and political speak for their own political agenda. There are a number of reasons as to why this is concrete. So in no particular order, my first one is China, second largest economy on the planet, of course. They are being increasingly marginalized by the West. And we're going to find over years, possibly decades, they are there's a reversal from what we've seen the last 30 years since they joined the World Trade Organization. And of course, all our manufacturing, quote unquote, went to China. That's going to reverse. So a lot of that manufacturing is going to come back to the West. Obviously, that's going to be inflationary. China itself has great problems. And I think that irrespective of the political aspects, just simply the economics are that there's going to be less exporting coming from China. We haven't got the time to go into the detail as to why that is, but I believe this is the case. And therefore, there's going to be more stuff being made in the West. So that's a big part of it. Probably actually the biggest part of the reason why we're going to see high and probably higher inflation for many, many years, and in fact, probably for decades, because as I see it, we are now in an era of financial repression, very similar, and the historians in your audience can look at the late 1940s to 1978. I believe that we're in a similar situation, and it started last year. So that lasted 30 years. There's no reason why this couldn't last 30 years. Clearly, we've got an enormous debt problem, and your audience will say, but we've had a debt problem forever, quote unquote. Well, yes, but now now they're doing something about it. Instead of course, reducing the debt, which they're not going to do, instead of raising taxes to kingdom come, which they're not going to do, instead of defaulting on the debt, which they're not going to do, directly in sense of we're not going to pay the debt, what they're going to do is default by inflation. And the means by which they're achieving that, going to achieve it over many years, and I'm talking about reducing the ratio of debt to GDP which across the world is about 300%. It's far too high. It's severely problematic. The inflation is going to, quote, inflate away the debt, unquote. They're going to reduce the level of the debt as a proportion of GDP over decades, which is effectively what they did post-World War II. And they're going to do it again. And the means by which they're achieving that, of course, we've seen a massive, beyond massive increase in money supply in the last 18, 20 months. We're going to see broad money rise, double digits per annum for as long as you can imagine. And that's the primary methodology by which we're going to see sustained high and higher inflation. We've also seen China. The third main reason, I'm conscious of the time that we have for this discussion, so I'm trying to keep it as brief and to the point as I can. The third major reason why it's beyond obvious we're going to have high and higher inflation is energy costs. The ESG merchants, as I call them, environmental, social and governmental, I think that's correct, who are, basically it's the provisional wing of the climate change con artists. It's the second biggest con in history, which is being played on you and me, the 95%. The top 5% are totally unaffected. They're going to carry on in their private jets, in their huge ocean-going yachts, and they're going to live the life of Riley. There's going to be fewer people at the airports. I'm not kidding. This is how it's going to play out. But the 95% are going to be massively affected by this. They're saying we've got to reduce this thing, this left, right, and centre in order to save the planet. Total con. The thing that's up in the sky, 98 million miles away, which is 300,000 times the size of our planet, that's the thing that affects our climate. Man does not affect our climate. Full stop. However, the ESG merchants have ensured that big oil hasn't been investing in oil discoveries and technology, for at least a decade. And yet, the demand for oil has rapidly recovered from the crash in early 2020. And it's still rising by 4 or 5% per annum, but we're not producing as much oil as we need to meet the demand. And the same goes for gas. So something's got to give. And the thing that's giving is price. I believe that about 18 months ago, in fact, specifically April 2020, we saw the generational low in the price of oil. And therefore, we're going to see the price of oil rise from that generational low, probably for a generation. We've already seen it rise from May 2020 from about $20 to about $80. Well, that's 300%, and it's the biggest input to the inflation indices, which, incidentally, as I'm sure many of your listeners know, are total fraud. That's one of the big cons that they play on us. There's no way on earth that the official starts are correct, about 4 or 5% per annum. According to shadowstats.com, which uses the methodology we had when Reagan and Thatcher were around in the 80s, we actually have 10 or 15% per annum inflation. Huge inflation. I mean, this is what I call super inflation, and we're rapidly getting back to 1970s levels of inflation. So, in summary, China, broad money, and energy, and those are the reasons why we have high, and we will have high and higher inflation for many years to come, along with the financial repression. It could last 30 years.
No, you mentioned how really the 95% are going to be affected. So the working and middle class, you've mentioned, those are the people that are going to be affected by this high inflation. What will that look like to them? If you kind of want to expand on that, what for the next couple decades, if we do see this high inflation?
Their cost of living is going to continue to soar. And, high inflation is anathema to economics, to economies, should I say. There's not an economy on the planet and in history that has performed successfully in high inflation. Because clearly, when you have high inflation and aggregate earnings don't keep up with the rate of inflation, then eventually the consumer, which is of course about 70% of the economy, starts to tighten its belt. So less stuff is bought. Eventually less stuff is manufactured. Businesses go bust, and we go into a downward spiral for 20 or 30 years. You won't remember it. In fact, you weren't around, but a look of you, it's the first time we've met. It's a pleasure to meet you. Your parents, ask them about inflation. Ask them what it was like. Times were tough. In the United Kingdom, by the mid-1970s, we had 25% per annum inflation, and we had a thing called the 3-day week, which is when the power workers, so anyone working in the gas world, the coal world, the transportation world of transporting these things, and indeed the oil world, they went on strike. So we didn't have the energy. So I can remember just eating our dinner in the evening by candlelight. Do I believe this is what's going to happen? And you know what? In 20 years, this sort of thing exactly could happen. In 15 years, this sort of thing could happen. If there is insufficient energy, which there probably will be, well, there's going to have to be rationing. The average family will be spending less going out. They'll have fewer holidays. They'll be spending less on stuff. Their standard of living will fall. Make no bones about that. Because, Elijah, the biggest tax of all is the one that they don't talk about. Inflation. Inflation is merely a political tax. It's not economics per se. It's a political decision. The average man and woman and kid in the street is going to have their standard of living severely detrimentally affected over the next 20 years. On top of that, their investments, 98% of portfolios are in 70-30 or 60-40 portfolios, equities and bonds. Well, government bonds cannot, it's mathematically impossible, do well in rising inflation. So your audience who've got a 70-30 or 60-40 portfolio need to look very, very carefully at what they're investing in. And it shouldn't be bonds for the long term. Bonds have done very well over the last 40 years, but that's all reversing now.
What are some sectors that you're looking at right now? Because you mentioned how, the traditional portfolio is going to be a 60-40, 70-30 ratio of stocks to bonds. The stock market, though, also seems to be very overvalued right now. So your perspective on the stock market, is that a place that you're looking at right now to invest in?
We're heavily invested in the NASDAQ 100, big tech. It's in a bubble. It seems to me it's very much like from the summer of 1999 through to the spring or late winter of 2000. And you guys should realize that in that short 9 months, the NASDAQ doubled. And we're we are materially invested in the NASDAQ 100. And it appears to me it's in a bubble. There's no reason at all on the face of it why it couldn't go up let's say 35 to 100% over the next 6-9 months. Well, that's returns that I certainly want to capture. And surely from I'm looking for the time. I can't see the time on my screen. Surely for the last 15 minutes that we've been talking, I'd be idiotic if I wasn't invested heavily in energy, which we are. My clients heavily invested in big oil and gas companies, as well as uranium mining companies. We'll perhaps come back to that. Let's talk big oil. The fact that the supply demand dynamics are so positive for the oil price and the gas price, it's irrelevant from an investing point of view that Exxon, Chevron, BP, Shell, Total, you name it, haven't been much investing in finding new oil. From an investing point of view, what's relevant is that the price of their product is soaring. And it's estimated that Texan oil companies make money above $55 oil. Well, we're looking at about 75, 80 as we speak. And I believe it's going to be 100 by the first half of next year. So big oil is making money hand over fist. And that's got to be distributed. We've seen oil, or should I say energy companies' indices double over the last year. I believe there's another 100 to 200% to come over the next 4, 5, 6 years. That's, again, a rate of return that I want to capture for my clients. And I believe that oil is going to continue rising at least to the end of the decade. I believe it's going to take out the 2008 all-time high of just under $150. I could easily imagine it going to $200. As I say, it's say 75 just now. Uranium miners have tiny market cap in total, like $50 billion or something ridiculous like that. The global market cap, it's ridiculous. And yet, you look at nuclear power, which of course the uranium mining industry supplies, it produces 11% of global electricity. It's remarkable. And yet one oil company is way more, is a multiple of the entire uranium mining industry. Fascinating. It's already gone up leaps and bounds since the end of the some 14-year bear market, which ended in March of 2020. It's already gone up 300 or 400%. But you know what? It seems to me that uranium miners as an index, find an appropriate fund, has got another easily 150 to 300% over the next perhaps only 2.5 years. We're in a major mega bull market. It's almost like Apollo 11. So yeah, big oil and gas and uranium miners. We've got a lot of money. We've got a major part of our portfolios in those areas.
Now, the key thing to keep in mind, as you've mentioned also in your newsletter, is that you have to make sure that the gains that you're making, they don't just look good on paper, right? But they're actually beating inflation.
Well, indeed. Although the official indices are, say, 5% per annum, I truly believe that real actual inflation is 10 to 15% per annum. So if you're not now, since the end of the crash, the end of March last year, if you're not making 10 to 15% per annum after fees, your purchasing power is diminishing. And it seems to me that if you've got 30, 40% or 20, 30% in bonds, you're probably not making 10 to 15% net. If you've only got, say, 60, 70, 80% in equities and the types of equities that are going to do well in inflation. I've given some recent past returns and say energy companies easily doubled in the last year. Uranium miners 300-400%, and the outlook for these things. So this is the kind of return that you need to be making, otherwise your standard of living is going to fall.
And what role do you see gold and silver playing? Because I know gold and silver have traditionally been seen throughout history as money, and people, when there is high inflation, often turn towards real money.
Sure. No, I'd agree with all of that. Isn't it interesting how badly they've done since August of last year? I think basically everyone in the industry or investing in the industry is mystified by that. It's no mystery. Miners and silver, as far as I see, follow not clearly 100% directly, but largely follow what gold does. And gold does not move with inflation, does not move with sentiment. Gold moves with real interest rates. There's a very high correlation. Rising interest rates, gold hates. Rising real interest rates, I beg your pardon. Falling real interest rates, gold loves. So, at the moment, real interest rates are strongly negative, and okay, sure, we've seen gold go up from 1675 to 1870. Fine. For me, I'm not touching gold right now. I was in it heavily last year. I'm not in it at the moment. Gradually this year, I got out of it. I had a heavy position. I've gradually got out of it. I am not convinced by this recent rally. I still see lower highs on the chart. And if your audience are somewhat technical analysts, look at the successive lower highs from August last year, and also look at short term how the market, the gold market, has broken short term highs, but has then gone lower. So multiple times we've seen major lower highs, but multiple times we've seen minor higher highs, which have been insufficient. And currently I see, probably, because there are no guarantees in this world, in the investing world, probably this is still another minor higher high. And I think there are still too many risks for gold and therefore silver and miners. And I am not going to be interested in gold and the miners market until we get back sustainably above 1950, or we crash below 1675, which is clearly a major support. Anyone can draw that line. It has touched it a number of times over the last roughly 15 months. So above 1950 sustained, yes, I'll be very interested. Below 1675, we could be going down below 1500, and you know what that will do to miners and silver. To answer your question now, longer term, I'm hugely bullish. I want to have a big part of my clients' money and my money in miners, particularly because they're so unbelievably cheap relative to gold and relative to where they have been and relative to that they're making money, because they make money above roughly 1100, 1200 gold. So they're making money and they're reducing their debts. Their balance sheets are much stronger now than they have been for many, many years. Silver is a great play. It may have bottomed out at about $20. I don't know. Currently, 20 is the base. Irrespective of whether it goes down to the low teens or not, or to put it another way, that it goes above 28 and indeed 30, which is the high of 2020. Irrespective of that, in 4, 5, 6 years, I think 150 silver is a piece of cake. It could be 250, do you know what? In a massive mega bubble straight up, like .com of 99, 2000, it could be $400 or $500. So yes, at $25, why not start building a holding? And so what if it goes to $12 or $15? It doesn't matter, because 5 years from now, I believe it'll be 150 plus.
And that's so key, I think, of slowly accumulating and doing dollar cost averaging in that way. Mm-hmm. Now, I wanted, before we let you go, one last point on the stock market. You mentioned how you want to catch that last wave in the stock market as we see possibly a 30 to 100% increase. Yeah. What are some indicators you're looking for that would tell you that the stock market is topping out?
Many of your your viewers will relate to this. When their mother or father says, should I be getting into the stock market now? When they see adverts or hear adverts, look at the stock market, you got to buy in, it never goes down. When every dinner table conversation is about the stock market, you know the point I'm making, when sentiment is off the scale. That's the first point. Just like in 1999. And you hear stories, anecdotes of this guy making $10 million by doing nothing and all that kind of stuff. Secondly, when the level of the NASDAQ 100 is so way ahead above of the 200-week moving average or the 200-day moving average, when in essence you get a chart which looks like the end of 1999. You know what, if we do see 50%, I mean, we're in the NASDAQ 100, which is about 16,500. If we saw 50% from where we are now, that's 25,000. Don't be greedy. So what, it goes to 30,000. Doesn't matter. Start coming out at that point. Don't be greedy. Sell 10% of your holding every few days, and enjoy what happens. Enjoy it. And also, perhaps contrary to what I just said earlier, it's entirely possible that the end of the bubble in the NASDAQ and the 100 could presage a recession like 2000 to 2002 and a stock market crash when the NASDAQ lost 80%. And government bonds would normally do well as market interest rates fall and we're in a recession. So short term, post a stock market bubble, yes, we might see a 6, 18, 24-month play in government bonds, but not for the long term, not for 10, 20, 30 years. So I'm looking at sentiment and I'm looking at how it relates to the 200-week and 200-day moving average. And I'm also looking at if I make another 50% from what I've already made, I'm not greedy.
All right. Well, Jonathan, we really appreciate your time today. Before we let you go, where can our viewers find you online? And did you want to share any last thoughts with our viewers?
I'll start with that last question. I mentioned China earlier. I'm extremely bearish on investing in China and Hong Kong. I would get all money out of there. It seems to me that the yuan could devalue at a moment's notice. It's a fixed exchange currency, astonishingly, for the second biggest economy on the planet. I just don't like the politics that's going, the authoritarianism that's going on in China. I think President Xi is now president for life, like Deng Xiaoping and indeed Chairman Mao, this is not conducive to China opening. It's more about closing, although Deng Xiaoping was opening, but I believe they're reversing that now. I would seriously be looking at getting all money out, and indeed specifically out of Hong Kong, because that's where most Western money is. On Twitter, I'm at Jonathan Davis, where the O is a 0. And if you mentioned the reports that I send out, you've read a couple, I believe. It's called the Booms and Busts Report. I write it every couple of months. The next one actually is due in the next week or two. It's about economics, markets, and a bit of politics. And I'm told it's a really good read. And you can get the details from my website, which you'll find on Twitter.
All right. Once again, Jonathan, thank you so much for your time, and God bless.
My pleasure. All the very best, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.